Information provided in this video is for educational and informational purposes only and should not be considered financial, investment, tax, or legal advice. Investing involves risk, including the possible loss of the principal. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The opinions expressed are those of the host and the guests and do not necessarily reflect the views of any affiliated organizations. Today, we're just going to talk about passive investing. This has been popping up quite recently over quite a few YouTube videos, and it's basically that are the markets getting significantly overvalued owing to the way the investment procedures have been structured? Now, it's a very important question to ask because we are seeing that in 2006, the US system changed that your 401ks, which is their pensions, it's the same as the European pensions. They went for what's called an opt-out system. So that means that if you pay into your pension or your 401k, you automatically get put into a pension fund, which then has to allocate your money to some structure. And a lot of the structures they picked are the indices themselves. So we're talking about the S&P, the Russell, the Nasdaq. So we were just going to talk about this, that how is this having an effect on what the value of these indices is, or I should say, and inside those indices, what are the values of the stocks themselves doing? John, I think we were talking about specifically some of the AI stocks. We've seen that the S&P now, I think it's over 35% of it is now the tech sector. And a huge part of that is the Mag 7s. Do you have any personal opinion about this type of investment by the pension funds?
Yeah, I think it feels to me when it was first introduced, it was quite a good idea, because a lot of people that trade in the market or invest in the market, they're over trading, they're paying too high fees, etc. Passive indices with the cheapest fee structure, uh, and you're not trying to beat the market, you're not going to underperform the market, you're just going to get the market return, which over time, again, no matter how far you go back 100 years, it's been a fairly healthy return relative to bonds and interest rates.
Mm-hmm.
Um, the problem now is that these funds have grown so large that they're no longer following the market. They're actually driving the market. When in the States, for example, over 50% of funds under management are now in passive funds. So at the end of every month, when these funds come to allocate their money, automatically, regardless of the company's underlying fundamentals, these passive funds will actually put money into these companies. And my fear is that there are a lot of traders, professional traders, who game this and who will try to game this. So they know this money is coming into these funds. They know roughly, they study and they pick up on exactly when this money flows into the market, and they try and get ahead of it. So this is an issue, and it leads to inflated prices. If the stocks aren't being bought on fundamentals, they're just being bought because they have to be bought. No one cares if they have bad numbers. A professional trader will know, well, actually, someone's coming to buy this stock no matter what happens. And if I buy it first and they come along and start buying it in pension fund size, in huge size, then I'll be able to sell it back to them within a day and make a small profit on my trade. And if I do this every month in multiple stocks across multiple indices, yeah, that's a pretty good way to trade.
Well, it's like in the States. Jeff, you probably know about this because you actually live there. A lot of the 401k money, i.e. the pension money, comes in on Thursdays. It leaves people's accounts on Thursdays, so it comes into the markets on Friday. Now, I have looked at the markets movements on Friday, and it's significantly more Fridays are up days than down days. Did you realize this was going on when you were living in the States? That was this when your 401k money came out on a Thursday?
Sorry, I just found that out right now. But you're telling me that comes in on a Thursday. Yeah, I don't think, from my perspective, when I had a sort of contributing to a 401k in the States, that's going back a long time. So there was pre the opt-in changes in 2006, I think, right? So we had a 401k. You assigned it to whichever company it was through, and you assigned it to whatever maybe risk factor that you wanted to assign it to.
Hmm.
It's a fairly standard procedure, right? So,
But that was an actual choice you made. Whereas I think the problem these days is that the money comes in on Thursdays, and as John was saying, you can front run all that money, which it's going to have to come in on Friday into the markets, and you can front run that, and that's why I like. I mean, Friday generally does have. If you look at Fridays, they're more generally up than they are down statistically versus any of the
mm,
other 4 days.
yeah, but I wonder. I mean, if there is an element of bit of front running there, yeah, it's fine. I presume it actually more supports the market, right? If there's flows coming in on a Friday,
Hmm.
but I mean, in terms of front running, I mean, it's possible.
Possible.
It's
And John, I'm not
possible.
saying that I'm not saying they're actually doing this, but is it just a case that the money comes in and there's a guy or girl reading the paper there and they just click buy, they just buy the index. That's it.
Well,
Is it
I've never worked on that kind of desk before, but yeah, I mean, I have seen a desk, and I've worked alongside people on a desk where they basically gave it to a machine buy every 30 seconds in the last half hour. And again, I was thinking that's madness. If I spotted someone and they're hitting market, buying something, buying something, buying something, buying something,
Hmm.
and I know it's going to go on for half an hour at this time, I'm going to be behind that thing too. And knowing that this guy's going to just hit market and buy it straight back off me,
Hmm.
that's a little bit careless now. I think it's a bit lazy, actually. I think.
Yeah. Well, you have these. You do have these sort of deep. They're the deep pools, which is depending on these brokers are so big. I don't know if they trade on deep pools, but deep pools are basically interpreting what the bid asks and what the trades are coming into the markets and just taking a little tiny, tiny cut out of it. But if they keep doing it for every stock, then they'll make a ton of money off it. Obviously, if they know that money is definitely coming in. So just talking about the big seven, then, right? So or just any sort of big cap. So let's pick Nvidia, right? They are just buying it, and so Nvidia itself becomes a bigger part of the index. But because it's now a bigger part of the index, then the following week they have to allocate more money to that. So it's a sort of self-fulfilling thing. I think that's what the whole downside of this type of trading is. Would you?
Well, I'll just maybe explain that really quickly, Phil. What happens
Yeah.
is in Nvidia, for example, say for example you've one stock it's 5% of the index and the stock is 1% of the index. So when new money comes into the market, that new money will allocate 5% of itself to the 5% stock, 1% of itself to the 1% stock. So
Hmm.
relatively speaking, the two stocks should move about the same amount. But the problem is the whole market gets elevated, not just Nvidia. Every single stock that's been bought in the index, and if it's a passive fund, it replicates the index by buying every stock. Everything gets pushed up, and again, it just doesn't matter what the news is. Nuclear bomb goes off. Their machine is trying. It's still going to buy the index.
Because it has that capital there to do
Well,
it.
yeah, well, it's its mandate. It's been told you have to buy this index. You have to replicate it. You don't care if it goes up. You don't care if it goes down. That's the good thing about passive funds. It takes a lot of the subjective judgment out of it. All you want to do is track it, because as I say, the S&P, etc. They all outperform the market over time. So, but the issue again is that the more passive funds that enter the market, the more hyped it's getting, and the less fundamentals play a role in determining a stock's value. So yeah, I mean, I think I don't know if again, I say over 50% of assets under management in the States are in passive funds. So but there's got to be a level at which these funds completely distort the market and the value of the market. I don't think we're too far away from it.
There has to be some sort of level, Jeff, as well, that the passive fund says, "Look, I'm not buying." I mean, surely, like, say a PE ratio goes to a ridiculous number. Okay, now I'm talking about a ridiculous number, and I'm not talking about the growth stocks here. I'm just talking about your average, say Coke, right? So Coke's PE ratio goes from its normal level to a ridiculous level. Surely the passive funds have to say, "Okay, we're just
Well,
not
you're
buying
you're
that."
you're you're matching the index, so Phil, aren't you? Right. So you're just buying whatever the index has. I'm sure that there might be something written in there, like if there's, for example, say some accountancy discrepancy or an accountancy overhang on some stock, that maybe they can, boycott that or temporarily, hold on. But bottom line, if they're just matching the indexes, then they wouldn't be, they wouldn't be matching the indexes if they're not buying all the stocks. So I would think that they're probably under a mandate to buy everything.
Yeah, I
Fair
agree with
enough.
that, Jeff. Yeah, I'd be pretty certain the mandate is buy everything in proportion to their percentage in
Yeah.
the index, and everything. Even if it's junk, it'll get pushed up.
Mm. Mm.
When I was trading in London, there was a thing called we used to do every day called statistical arbitrage, and it was basically that the boffins would figure out these statistics of the FTSE 100, and they would sell half of them and buy half of them of the 100 stocks. One day though, Vodafone started their share price started to fall, and then the following day it fell again and again. And what was going on was Gordon Brown was making people bid for the phone licenses, which is what they weren't expecting. So statistically, the machine kept buying Vodafone, even though we knew Vodafone's price is going to drop by about 30 to 40% at least, because it has to pay up a massive amount of money for these licenses. But the Boffins wouldn't turn it off. So it
Mm.
was just like it was a kind of insane trade. It was kind of like you do know you're going to be buying more Vodafone tomorrow. I mean, I can tell you that. And yet they said, no, it's all part of the actual stats, which is fair enough. It is, but it was just that was just one example I
Yeah,
can
but
I
again, I
can
suppose they were sticking by the rules, right?
Yeah, they're basically
Of what
following
they
their
were,
mandate. Yeah, that's all.
yeah, because like they can't turn around and go, you know what, unless the rule says that they can alter by a certain amount, but
No, they
y-
actually couldn't. No, which is the sort of tragic thing. So what
mm,
happens then? I have to ask, what happens then if the outs for these funds are to do with pension dates? Okay, so um, if you're filling out your form in the states, you give a date, like 10 years, 20 years, 30 years, 40 years of when you'll be out or when you want your money back. So it's kind of like these funds will just keep going up until allocations are needed to pay pensions. So it really is based on then the future job growth in the US that
mhm,
these funds will stay as they are. Because if the average age gets to sort of 62ish, 65ish, then if there's more money coming out, then these funds will have to do the exact opposite. They'll just
Yeah,
have to sell.
that would
yeah,
absolutely collapse the
yeah. If
market
the
and
contributions aren't
fast.
coming in, yeah, yeah, or they're not coming in as much, due to recessions or whatever. Absolutely, yeah,
Yeah, so if,
yeah.
if redemptions were greater than allocations, again, say for example, people, 60% of the people in the fund have reached retirement age. So the fund needs to, instead of allocating money to stocks at the end of every month, it needs to take money out of stocks every month. And that becomes the dominant theme. Then, yeah, the market could absolutely collapse. Good stocks will be sold, bad stocks will be sold, everything will be sold. So, but at the moment and for the foreseeable future, this is not likely to happen
No.
because there are more people of working age than of retirement age. But you know, it's I'd say it's almost like a house of cards starting to build up. The larger the passive funds become, the greater the influence they have. The older people live, the more people there will be in retirement relative to people in at working age. So realistically, it's probably not a problem for the next 20 years, but flagging it now, it will build up and it will become a problem, and it'll become a problem that governments will not be able to deal with.
Well, I think that could be one reason why governments, especially in the Western world, are so desperate to bring in people to live in their countries in order to, because as the population is getting older, there's less demographics, there's less children being born. So I think that this is one reason the governments would need people in the population in order to keep this going. Like as you say, if the if the apex of that curve is reached, or if the differentiation, John, of the curve gets to zero, then or at that point where the slope is zero, then this thing is just going to go the other way. And
Yeah,
if people know that, then there's trouble ahead. But as you say, I don't think there's anything to worry about for 10, 20 years.
yeah.
It'll
I
just
was
keep going.
I was going to say there is a slippery slope when they have to do more redemptions than allocations, when they're selling out more than they're buying in. And the problem is when they sell it out, the value drops, which means they actually need to sell it more to get the right amount of cash to pay out the pensions, the pension liabilities, which means the price gets pushed down further. So again, you can picture a scenario in 20 years from now or whenever where the market absolutely crashes in the back of these funds trying to meet their pension obligations, and they are one of the main buyers, if not the main buyer of stocks and shares. So when they disappear, I mean, who's going to buy them off them so they can meet their obligations? It's a little bit scary. Not one for today, but again, governments they need to be on top of this kind of stuff. And to be honest, the problem with a 4-year government or a 5-year government is they're not on top of this stuff because it doesn't affect them. Their job is to get elected and get re-elected, and that's it.
And that's
Their
it.
their their time span doesn't appear to go past 5 years, maybe 10 at best, with the exception
So,
of China.
of course, except in China. So, Jeff, can I just so if you're trading a stock which is in an index, should that be one of the first things you look at? Is what index is this stock in? Because if these passive funds are coming in, it has a bias to the upside, obviously. Well, all stocks have a bias to the upside. Well, most. But you know that if
Well,
it
yeah, just on that, I'm pretty sure Accenture is in some indexes, right? So, and
yeah,
Cognizant was in an index. So you pay attention to those stocks. Well, I mean, they're down, right? So it doesn't mean that at the end of the month when the cash in the flows come in, they aren't bought up a little bit along with everything else. But the fact that they're down versus other stocks that are up in the index doesn't mean I don't know how you're comparing the flows coming in with the different stocks in the indexes, if that makes sense.
yeah, fair enough, fair enough.
So they got hit on the back of, I suppose AI, going forward.
Yeah,
The passive monies will come in at lower levels and buy them,
right.
right? But the stock itself is not deemed to be, say, a very sort of a good growth or, a good stock for the long run.
Yeah.
Right. So I
So
don't,
if you so if like within Europe now we have an opt-in system. So all our pensions now are opt-in. You have about I think the first 6 months you have to when you start a pension you have the choice to opt out. Now opting out means picking your own things. It doesn't mean that your broker will just follow the index funds. It's a difficult one to know what to do. I mean, you know for me it sounds like the best thing to do is opt in. You know, for
yeah.
any pension really for the time being.
Well,
I
you're leaving it to professional managers technically, right?
that just push a button every Friday. Those
Well, but
guys.
their money's there. You're not worried about it. You're not thinking about different indexes, different countries, different risks. You're in the same. I suppose technically you're in the same boat as everybody else, right? So
Yeah,
if the market's down, the market's up. So I think if it's not your mantra to trade and to try and seek a return above the market, then you're better off just really trying to match the market.
yeah.
Guys, I have an interesting one for you guys. I was actually reading today only about the difference between women and men in investing, and it was saying that women on average produce about 0.4% better returns than men, through their pensions, etc.
Oh, really?
And the reason is that women in general will go for a passive fund, which will match the index, and that's all they do. Whereas men are more likely to try, I'm going to pick a winner here, I'm going to jump into this hot sector here, and they're just racking up fees. So the actual stats are actually in favor of women as being better investors than men by just doing passive investing.
Mm,
So,
Mm,
there is something for it that way. But the issue here again is the passive investing has become so big. It's no longer really passive. It's actually what's starting to
mm,
drive the market. Now you were mentioning about Accenture coming off. That would have been people fundamental investors who are still very significant within the market, saying no, they're going to lose traction. It's going to go to AI. They're switching the funds out of here, pushing it down hard and fast, and putting
mm.
the funds into AI, and again pushing that to the upside hard and fast as well.
mm,
So
But I think one aspect about passive funds, which you have to think about, is like passive funds aren't watching out for shares that fall.
no,
You know, they have a time of the week that they just push the button and
Yeah,
bang, it's done. So as you say, John, the professionals can drop stocks down or bring stocks up. And when the passive guys and girls come in, they just push the button at that time of day. And it's so a stock could be down 10%, doesn't make a difference to them. They have to buy it as part of the allocation of the index. And that's it,
exactly.
right?
Yeah,
Yeah.
yeah.
Okay.
Yeah, but I just think my issue probably with it would be that
One of your issues, Jeff. One of your issues.
well, one of the with the passive investing, I have a lot of other issues in the background. It is sort of it does sort of inflate a lot of the bigger stocks. Then a lot of money flows in there if they're in the index, and it keeps flowing in there, and technically then it sort of inflates their size, and then should therefore drive down the relative sort of cost of capital they have for their borrowing.
Yeah.
Also, they can, technically the companies then could sell shares and buy into other firms, and other firms they can then technically have more of a competitive advantage of
Yeah.
firms that might be in the index, and therefore, it's a sort of a self sort of rolling thing where that firm, in the index is kind of getting bigger and bigger, where the ones outside, the capital's not coming in, and they're under, the borrowing costs are higher, and it's harder for them to compete.
Well,
Right.
can I comment on that as well? It's
Mhm.
interesting what you just mentioned there, Jeff, because we saw prior to the rebalancing of the Nasdaq 100, when
Mhm.
CoreWeave and Nebius joined the Nasdaq 100 and Cognizant came out of the Nasdaq 100. Just prior to that, we saw Nebius take a huge ramp up. And this
Yeah.
rebalancing, the stocks are based, largely based on market cap, a few other factors as well, but mostly market cap. And these decisions were made on the 29th of May this year for this particular rebalancing. Uh, it was interesting, the fact that they ramped the stock up, brought it to a nice market cap, it joined the index, and now it's got all these automatic buyers attracted to it. So
Mm.
it seems as well, if you are a trader or an investor, picking stocks that are on the rise and outside these indices, and which aren't being held up by passive funds, etc. If you can find these stocks before they join the index, you could be onto quite a hefty winner.
Mm. Absolutely, yeah, yeah. Well, I mean, then I suppose that, I suppose technically they're entering the indexes, right? So it means they are going to be bought now, and the ones
Yeah,
that are exiting technically they're not going to be bought, right?
yeah.
Because they're no longer in. And do they get sold then? Or are they
Well,
just
they'd
part
have
of
to.
the
They'd have
process?
to. They would have been sold prior. The passive funds would have had to get rid of them,
Mm.
and they would have had a deadline. I think the deadline for adding stocks that were
Mm.
joining these was about the 22nd of June this year. And so, yeah, equally, they would have to
Right.
offload.
So I think, well, there you go. I mean, that could be decent enough outflow
Oh,
from
huge
those
outflow,
specific stocks.
absolutely
Yeah.
huge outflow.
Mm.
Considering that most of these things are held by these companies. But again, for guys like us, that would produce, well, actually, that's a good value stock now. It's going to produce, maybe it's on the index, maybe it doesn't have all these buys, but it's going to give me a really good dividend return every year because the
Mm.
price is just halved.
Yeah.
Um,
Yeah.
so it's an opportunity as well.
Yeah.
John, just go back to what you're saying about the women and the men, John, versus passive. If you have €1,000 and you buy four stocks in an index, or you buy four stocks individually, so 250 each, approximately what's the difference in the fees on that? Just like a ballpark. So say you buy the index, you either take your 1,000 buy the index, or you take your 1,000 and you buy four shares for 250 each.
Oh, well, again, depends how you buy them, what platform you use. For example, I use IBKR, and
Yeah.
for every transaction I make, I get charged about €5.
So
And
the €1,000 that you buy, you'll be charged €5. However, the 250s by four that you buy, you'll be charged €20.
yeah, exactly. That's the way it works. But again,
Okay.
everyone's got completely different fee structures.
Yeah, fair enough.
They say the average cost or around the passive funds is only 0.1%, which is again very, very low. But
Yeah.
again, they don't do all they do. They know there's no planning needed. They know, okay, we're buying this much of these things across the board. No decisions, no calculations needed. It's very straightforward for them. So
Yeah.
they can't. One of the main attractions of passive funds is that the fee structure is so low.
Yeah. I'm not sure. I mean, it's the fee structure, but it's also, remember we looked at before, the percentage of sort of trading accounts tend to lose money.
Yeah.
Like it could be 80%. So therefore, if you think about it, if you're just selecting a passive fund that somebody's doing, or you're thinking, no, I'm going to beat the market here, and therefore you're putting yourself in that 80-20 risk that you're probably not going to make money anyway
Yeah.
on it. So I think if the more you think you can beat it, well, so it's the fees, but it's also the fact that, yeah, you might win in one or two, but there's a good chance that when you start losing, you won't know how to deal with that.
Well, that is the biggest thing in
So,
trading. You gotta know how to deal with losers, and you gotta just know when it's time to move on.
Yeah.
Okay, look, we're just going to finish up. There's one last thing that what I was noticing about the conversation about this, and it's the bifurcation of money going into businesses. That with these index funds, all the money is going into that. It's not going into Main Street. So if you look at the streets of of cities and towns, they really are getting less and less as individual businesses are able to do these, because you're having huge companies now are buying up real estate, they're buying up homes, they're buying up apartments, all under the guise of funds, and that's what they're
Yeah.
actually doing. So you're getting this huge bifurcation of economics. And I think we're starting to notice that within Ireland. I see that now where, a certain chain of coffee, you'll have one chain of coffee shops and that's it. And
Yeah.
there's no sort of mom and pop stores, because there's no way they could actually compete
No,
against these huge chains.
you can't really. And again, Ireland's not designed for small businesses. In fairness, the amount of red tape. You gotta do this, that, the other. It's madness.
Well, but I
It's
think
just
the US is the same. You know what I mean? For small businesses, I mean,
yeah.
imagine setting a small business up in a medium-sized town or small town in America when you're competing with Amazon and Walmart, and very difficult.
Yeah.
Yeah, but that's
Well,
what
it's
we're talking
also
about. That's what we're talking earlier on about the money getting put into the the bigger companies, and then they have a competitive advantage, and
Yeah.
that just grows and grows and grows. You know.
and you just can't take them on. Like
Well,
like
it's
even this like the guy I was listening to, he was talking about a car dealership in a small town in the States, and there used to be like 7 car dealerships and all that stuff. So
yeah,
there'd be sort of competition about the price of cars. But now one giant corporation owns all 7 dealerships. Okay,
Well,
so the salesmen have been told not to compete, so they don't get paid sales com anymore. They just get paid to be there, right? So they won't do you a deal. So say a car is $20,000, they won't give you 19,500 because it's just a loss for the company that owns all 7 shops. Like
yeah.
but that's how all this is. That's the big change I see happening on actual Main Street now with all these funds and the behavior of them. That's just my own 2 cents. That's all.
yeah.
Yeah,
You
but
know.
then you take your 7 shops, right? Your 7 shops of the salespeople and the account staff and the secretaries and the management, the bosses, and then when you have the 7 shops, you have to, you need 50% of all the employment, right? So
Yeah.
therefore, we were talking about earlier on about the flows going into pensions and into whether it's auto invest or whatever. Um, there's an example of when labor is being cut down on, so the contributions aren't going in. Certainly not to the same extent.
Fair enough. Fair enough. Okay. Well, look, that's hopefully people have learned a bit off that about I suppose what can they learn off that is the opt in, opt out. It's a choice you have to make, but also something to be conscious about. I suppose. I mean, that's like generally, what would you say that the average investor can learn off what
Well,
passive is?
at the moment, yeah, go simple. Keep the fees. The only thing you control. Go for stuff with low fees. Follow the market. Everybody else is doing it. You're in the herd. You know, you're good for a while. You're good for the next 10, 20 years. But after
I
that, you
suppose,
can
yeah, yeah,
come back to us then, and we'll see if we
yeah.
have any recommendations at that stage, or we figure it out ourselves. Even.
Okay, fair enough. Fair enough. Jeff, do you have any last points to add there?
No, I think
Well,
again, a lot of people got a lot of other bigger problems. When you're looking at longer term,
yeah,
just go the easy route there and investing, I think, and
happy enough.
whatever, maybe try and upscale or learn certain other things, and instead of
Yeah,
worried about maybe trying to beat the market in a pension, which you may not be able to do. you know.
Yeah,
yeah.
So yeah,
yeah.
Or else go out there and give it a go. One or the
yeah.
other.
You're saying give it a
Roll
Okay.
go,
those
eh?
dice.
Oh yeah, sure. Why
Roll
not?
the dice. Yeah.
Okay, that's 30 minutes. We'll wrap it up there, boys. Listen, we'll see you
Okay,
on Monday.
thanks very
Okay.
much, guys.
Thank you.
Cheers, guys. Bye. Bye.
Bye now. Bye bye.